The payables turnover ratio is an important financial metric that assesses how efficiently a company is managing its accounts payable. This ratio provides insight into how quickly a company pays off its suppliers, reflecting its ability to meet short-term obligations and manage cash flow effectively. Unlike other financial ratios that might focus solely on profitability or liquidity, the payables turnover ratio specifically highlights the operational efficiency related to supplier payments, offering a different perspective on the company's financial health. Payables turnover ratio. The payables turnover ratio measures how many times a company pays off its accounts payable during a specific period, usually a year. To calculate this ratio, you divide the total amount of purchases made on credit by the average accounts payable balance. Essentially, it shows how quickly a company settles its supplier bills relative to its total credit purchases. Compared to other ratios, such as the receivables turnover ratio, which focuses on how efficiently a company collects receivables, the payables turnover ratio gives a view into how well a company manages its obligations to creditors. To determine the payables turnover ratio, start by adding the beginning and ending balances of accounts payable for the period, and then divide by 2 to find the average accounts payable. Next, take the total credit purchases or cost of goods sold, if detailed purchases are not available, for the same period. Finally, divide the total credit purchases by the average accounts payable balance. This result indicates how many times the company has paid off its average accounts payable during the period. Example: suppose a company's beginning accounts payable balance was $50,000 and the ending balance was $70,000. The total credit purchases for the year were $500,000. To find the average accounts payable, add $50,000 and $70,000 to get $120,000, and then divide by 2, which equals $60,000. Next, divide the total credit purchases, $500,000, by the average accounts payable, $60,000, which results in a payables turnover ratio of approximately 8.33. This means the company paid off its accounts payable roughly 8.33 times during the year. Low payables turnover ratio. A low payables turnover ratio suggests that a company is paying off its accounts payable slowly. This could indicate that the company is struggling with liquidity and might be delaying payments to manage cash flow. It could also imply that the company has favorable credit terms with suppliers, allowing it to take longer to pay its bills. However, if this delay is due to financial difficulties rather than negotiated terms, it could harm supplier relationships and lead to potential supply chain issues. High payables turnover ratio. A high payables turnover ratio indicates that a company is paying off its accounts payable quickly. This can be a sign of strong cash flow management and financial stability. Paying off accounts payable quickly might also suggest that the company is benefiting from discounts for early payments or has a well-managed procurement process. However, if the ratio is excessively high, it could imply that the company is not taking full advantage of favorable credit terms or might be missing out on opportunities to improve cash flow by extending payment terms. How can companies optimize the payables turnover ratio? Negotiate better terms. Work with suppliers to secure more favorable payment terms that balance cash flow needs with supplier relationships. This could involve negotiating longer payment periods or taking advantage of early payment discounts. Improve cash flow management. Enhance cash flow planning and forecasting to ensure that funds are available to meet payment obligations on time. Efficient cash management helps in maintaining a balanced ratio. Streamline accounts payable processes. Implement efficient accounts payable processes and systems to ensure timely and accurate payments. This can reduce errors and delays, helping to maintain an optimal ratio. Key takeaways. The payables turnover ratio provides insight into how effectively a company manages its supplier payments. By analyzing this ratio, businesses can gain valuable information about their cash flow management and supplier relationships. A high ratio indicates prompt payment of accounts payable and potentially good cash flow management. A low ratio might suggest slower payments and potential liquidity issues, though it could also reflect favorable supplier terms. Companies can optimize their ratio by negotiating better terms with suppliers, improving cash flow management, and streamlining accounts payable processes.